What if I told you the reason partly why Tesla stock has been the worst performing stock in the S&P 500 to start 2024 is because of Nvidia? Yeah, that's right. And what if I told you after Nvidia's earnings, Tesla stock may actually start to do very well? Because let's be honest, nothing actually changed for Tesla. Tesla did some minor price reductions in Canada, but really, it's the same Tesla. Of course, we did not give guidance and there is uncertainty around Elon's comp package, but does that really quantify Tesla stock being the worst performer in the S&P 500? No, absolutely not. So, oh man, I cannot wait for this video to marinate over the weekend. I want each and every single one of you guys, if you could, to comment down below. Let me know what you think about this information. We are going to get into data here, raw data. This is not an opinion-based video on what's going on with Tesla stock and the broader market, specifically inflows. Why are inflows actually negative for the S&P 500 this year? In January and so far in February, but yet the S&P even today just hit a new all-time high. We have all of that for you and much more, including what Dan Ives just said about Tesla stock and what I believe Tesla stock will do here in the next coming months to reassure investors. Well, this could have a very positive effect on Tesla stock as well. We will go over some interesting charts and statistics on our markets. So I think the first thing we have to acknowledge, this is really the basics. You need to know this before we get into the video even further. There is a chronic liquidity problem in our markets. It's not that stocks and companies have been doing bad over the last couple of years. Look at PayPal, just had a record quarter. The stock is down from $300 as its high in 2021 down to like $56 today. PayPal's been doing fantastic. Fubo's been doing fantastic. Tesla has been doing fantastic. In the grand scope of things, Tesla has been doing just fine. I mean, then look at a stock like an Apple that just seen a 1% growth rate in the last almost year and a half. My point is, some stocks have been doing very well, but there is this chronic liquidity problem because the bond market pays you out 4 to 5% depending where you are on the curve. Nobody wants to take risk in equities right now, especially when there has been this overarching fear that the Fed has raised rates at the most aggressive pace they have in 40 or 50 years. The narrative was we had to go into a recession. Now a recession looks, well, not as likely as it did before, but you're still not getting money rushing back into our markets because you still have 10-year, 20, 30-year treasuries and even shorter term duration treasuries paying you 4 to 5% across the curve. You can actually see this in the SPY here on ETF.com. This is looking at inflows and outflows. You really didn't see much of inflows at all to the S&P 500 in 2023. Very minimal. Besides what we've seen in December, which was about 38 billion worth of inflows. Again, still in the grand scope of things, pretty small, relatively speaking. The next highest month you've seen was May, and that was only 11.5 billion worth of inflows. And for the entirety of the start of 2023 until now, you have only seen about $12.7 billion go into the S&P 500. That is very minimal. I mean, think about Tesla stock today. It's a $600 billion company. $12 billion not going to move anything. Like literally, $12 billion would probably cause a 0.1% move, potentially less on the S&P 500. Like literally nothing. It's nominal. So what's been happening is, well, it makes a lot of sense. Investors have said, hey, if we go into a recession, where do we want to be? That's clearly in big tech. I would rather be in Microsoft and Google and Amazon if we head into a recession than your small mid-cap stocks. That's a definitive fact. So what has been happening over the past really multiple years now is you are seeing capital being drained from the lower sector of the market and put into the higher sector of the market, specifically around your Magnificent Seven. I guess people are excluding Tesla now, so Magnificent 6 stocks, and those have large market weightings in the S&P 500. So you actually don't need to see inflows into the S&P to see the S&P continue higher. This has recently gotten much much more extreme. Really, to start 2024, the S&P 500 hit a new all-time high today on Friday, but even since the beginning of January, you're up about 5% in the course of a little over a month. Now, a vast majority of this rally has been due to AI, and it's really exacerbated the trend that has been happening for years now, taking money from the lower sectors of the markets, putting it into the higher sectors of the markets, which are your big tech names like a Microsoft, a Google, an Amazon, any company that's a big tech name that associates themselves with AI. They're almost forced to at this point, whether they want to or not. They're seeing more inflows, and that in turn pushes higher the S&P 500. And I mean, you can even see this looking at yearly inflow numbers for the S&P 500. Going back to 2021, you had inflows, net inflows of about $38 billion. 2022, outflows of $12.4 billion. 2023, you had inflows of $48 billion. But take a look at 2024 already. Outflows of $36.5 billion, yet the S&P's up 5%. Again, the money is just pooling into the largest names. Now, normally I would have to sit here and say, hey, why is this happening? Of course, it's been happening for years because of the recession fears. Now, in theory, especially once the Fed starts to reduce rates, it looks like the markets are pretty certain around May being the first rate cut. So here pretty soon, markets should start to broaden out in anticipation of the first rate cut. The only backdrop to this theory is if we actually do go into some kind of recession, then it would make sense to continue to see this clustering of capital in your big tech names, but that does not look likely. It also does not look likely that inflation is going to reaccelerate from here. Even if it takes a while to fall, it looks like we're still going to get at least 2 or 3 rate cuts in 2024, which again should help broaden out our markets. But with all of that being said, why am I talking about Nvidia in a relationship with Tesla? Why are these two so connected right now, in my personal opinion? Well, Tesla has had problems. Tesla did not give guidance. Tesla's management really doesn't know their left from their right, and some people were a little confused when I said that the last time. What I mean by management don't know their left from their right. They don't know how to communicate to markets. They don't know where they are going publicly as a business, right? They might know privately what they're doing, but they are not expressing that to the markets. They are being very, I mean, if you were to meet someone like this in real life, you would call them shady, right? Tesla is like a shady company right now in terms of not telling the markets what they're doing, just doing things, right? Who knows when margins are going to bottom? We don't know where the business is going to be. That's all fine, but at least say that. At least be honest and be straight up, right? So Tesla's had some problems, and this doesn't change the long-term narrative or even the short-term narrative for Tesla. I think you got to really look at things. Has the situation changed with Tesla? Have the fundamentals got worse? No. Does Tesla have a communication problem? Of course. Yes, that's obvious. Does that make sense to why Tesla has lost $200 billion of market cap value since, I mean, mid-December? Not really. I don't think a $200 billion market cap loss makes a lot of sense from the new information we got from December until now. After all, nothing changed with the business, but that is just a tale to how important it is for a company to be vocal and some would argue positive about the business going ahead. Throwing uncertainty at investors is worse than bad news. I don't care if Tesla guided for 1.8 million deliveries, the same as 2023. I think Tesla stock would have probably performed better. Now back to the situation. So Tesla has lost $200 billion of market cap. For anyone that does not know, the Russell 2000, the index, is only worth about $2.3 trillion, the entire thing. So Tesla's loss in market cap in just the last 2 months or so is about 10% of the entire Russell 2000. So this money has left Tesla stock, $200 billion. Where has it went? It hasn't went into small caps. It hasn't went into the rest of the markets. It's went into big tech, I would argue, Nvidia specifically. Because when you just look at the dollar amounts of market cap and how it's increased in Nvidia, how it's decreased in a stock like a Tesla, I mean, that's the only logical conclusion that I can make. I mean, during this same time period, Nvidia has went from a $1.2 trillion market cap until today at about $1.75 billion market cap. That's an increase of about $500 billion. No wonder why the lower half of the markets have not been doing well, represented here in the percentage of stocks above their 50-day moving average. Still only at about 54%, even though it got a little bit better today. I mean, you've fallen from 86% to a low of 45%. At the same time the markets were rallying. It's Nvidia. The money is pooling out of certain sectors and going into Nvidia. And just for context, again, Nvidia is almost the entire size of the Russell 2000. So one stock like Nvidia, trillions of dollars, is huge. So it's pretty clear. This has been what's happened. Money has went from Tesla, $200 billion worth. I would argue at least $100 billion of which has probably went into Nvidia directly. You could probably split up the $100 billion extra and into, Apple, Google, Amazon, Microsoft, SMCI, some of your other semiconductors as well. But I do think a vast majority of it went into Nvidia. Now, there's a specific reason for this because hedge funds are institutions. They do not want to lose clients, right? They cannot not invest in AI right now when everyone's talking about it. It's very hard to sell a fund and get investors to invest in a fund right now that is not going to the moon like Nvidia is. It's very easy to promote that you're owning Nvidia, that you're raising your price target on Nvidia. Come invest with me. Nvidia just went from $100 to $700. That's just the way people work, right? They love that. They would rather invest in Nvidia at $700 per share rather than, let's say, Tesla at a almost 52-week low. Now, obviously, things will change. And I do think we started to see this correlation very closely on February 6th. Now, February 6th, really for no rhyme or reason, Nvidia was down about 4% at one point. Nvidia ended up closing the day down about 1.6%. What happened? February 6th was the change for Tesla stock. That marked not the low necessarily. The day before that was the low, the ultimate low at $175 per share. But the next day after, you hit a low of $177. You ended up closing at $185 per share. For Tesla stock, this is Tesla stock we're talking about. Tesla was up 2.23% on February 6th. The first day Nvidia really gets a red candle, like a significant one. And really, Nvidia hasn't even been red besides that. At all. It's been a long time. Holy crap, it's really been a long time. Besides February 6th and yesterday, that slight red we seen, the last time Nvidia was red was almost a month ago on January 17th. So it's been a continuous flow out of Tesla into Nvidia. Even yesterday, Nvidia was down about 0.5%. Tesla was up 1%. Tesla's actually been green 4 days in a row ever since you started to get the first sign of weakness or slowing down in Nvidia stock. Now today, Nvidia hit $720 per share, so it's back on the move, but I do think there is this correlation that is happening. Now, Nvidia earnings will be on February 21st, I do believe. You guys can double check. Let me know down below in the comment section. But I believe February 21st. It's not next week. It's the following week. I believe it's on Wednesday. Now, Nvidia, over the past 3 earnings, has really shocked the world, impressed the world. But after that first initial gap up, Nvidia has not gapped up after earnings ever since. Nvidia actually ends up falling after earnings. The last 3 earnings, you've actually seen a fall after Nvidia earnings. Not the day after Nvidia earnings necessarily, sometimes, but over the next week or 2 following. 3 earnings ago, Nvidia fell 12% following earnings. 2 earnings ago, this is the one you guys might remember, Nvidia was up like 10%, ended up selling that off as soon as we opened for trading, and then actually fell another 2.5% the next day. But from that high over the next, call it month or so, Nvidia actually fell about 18%. And the last earnings we had, Nvidia, ended up falling about 2.5% after earnings. And over the next, 2 weeks or so, Nvidia ended up falling about 11%. Now, why did Nvidia sell off the day after last earnings? Because everyone was expecting great earnings. When expectations are that high, there's nothing Nvidia can do to get the stock to go higher. That looks like how we are positioned right now. Question is there anything bad in there that causes Nvidia to fall like 10 or 20%? That I don't think would be good for Tesla. If Nvidia were to gap down huge on earnings, probably not going to be good for Tesla. But if Nvidia does this slow bleed down of, let's say, 10 to 20% this time around, I could see a lot of capital going back into Tesla stock. Now, a 20% move down from here would put Nvidia at about 574. I think that's pretty reasonable. Could you fall even to as low as 550, 500? That could also make sense. And that would unlock hundreds of billions of dollars to go back into other areas of our markets. Now, when I sit here and think about this, could this negatively affect the S&P 500? Yes, I think it could negatively affect your AI names following Nvidia earnings. But I do think, let's say you had the top 10 stocks in the S&P, Nvidia, Apple, Google, Amazon, the whole shebang, falling, let's say, 1% apiece. But let's say you had the rest of the markets just roaring because all of this capital got freed up. We're not going into a recession. The Fed's about to cut rates. In theory, you should be buying the rest of the markets and not big tech. Let's say the rest of the markets are roaring. Is that really going to cause substantial downside in the S&P 500? Probably not, but it could start to shift the way capital flows. And at this point, I think Tesla stock would benefit a lot from a weak Nvidia following Nvidia's earnings. With that being said, if I am correct, and if Tesla, at least half of Tesla's market cap loss, $100 billion or so, has likely went into Nvidia. If Tesla were to get a portion of that back, I think Tesla stock could easily make its way into the low 200s again. 210, 215, 220 could be pretty obtainable. Your 50-day moving average sitting at about $225 per share. I think that's a good level to be targeting. After all, like I previously mentioned in the last two videos, RSI has just now went positive. MACD has just now went positive. These are both really good technical indicators to support a larger rally to come. Now, I did make a trade on Tesla stock today in the private trading community. If you guys want to come join that, check out the link down below in the description of this video. But again, I want to be very clear. Is it a certainty Nvidia falls? No. If Nvidia does not fall and goes up 10 or 20%, Nvidia is going to be over a $2 trillion market cap, and it's just going to be egregious at that point. So I think your odds here are like 90% chance we fall, 10% chance we rally. Nvidia tends to do this, guys. Nvidia tends to rally leading into earnings and then sell off after earnings. The last 3 earnings, that has happened. Now, this time around, the buying before Nvidia earnings started a lot sooner. So I don't know if Nvidia is going to rally straight into their earnings or if you could see a cool down period. Not exactly sure, but I'm pretty confident in this. Let me know what you think down below in the comment section. Now, on a completely different note, let's take a listen to what Dan Ives just said about Tesla and what the board should do next.
Wedbush out with the new note on the EV leader saying, quote, "It is time for the board to change the Tesla narrative with 3 things that need to occur to make change happen." For more, is the man behind the note, Wedbush Managing Director Dan Ives. Dan, best dressed man on Wall Street as well.
Great to be here.
It's okay. 3 things. Number 1, create a new comp package that supersedes this 2018 one. What do you want to see?
Look, a $40 to $50 right now overhang on the stock because of this. The Delaware situation, I believe they need a comp package to supersede the 2018. Ultimately, Musk gets that package. This has been...
You want to see him get paid?
You want to see him get paid. This has already been approved by shareholders. Stop the nonsense. And I think this is something that the board needs to act now.
So, I mean, the judge in Delaware, of course, everybody's saying, oh, it's politicized. Who knows, whatever. But you think the board needs to come up with something new to compensate Elon Musk. By the way, keep him there, keep him happy, and keep that AI in-house because he kind of threatened to walk.
Musk is the heart and lungs of Tesla. Tesla is Musk, Musk is Tesla. And I think that's something that's very, very important at this juncture. Clock struck midnight. Board needs to come out and act.
Also, and it's related to that, the company's headquarters is already in Texas. But you think they need to, and Musk has said he may do this, legally move the state of incorporation from Delaware to Texas?
I think it's not a question. They have to. I think not just from a Delaware perspective, you got to move to Texas at the shareholder meeting, put that up. I think the board needs to come out with a statement, and then the Musk 25%. In terms of getting Musk to the 25% voting, obviously a lot of controversy there, but Brian, it is so important that AI, and we believe could be one of the biggest AI stories out there, AI stays under Tesla, which is, I think it's a pivotal point to make sure that Musk stays at Tesla through 2030 at least.
Tom Lee, the man, the myth, the legend himself, says he also agrees with Dan Ives. And that would probably be very bullish for Tesla stock at this point. Again, get Elon paid, get moving on to something more important. Now, I actually had a couple people comment on the last video saying that Tesla stock will probably start to do better once Elon actually has a compensation package, which I guess I took Elon's word for it, that it's not about, economics, that he just wants more voting power, but maybe it's not about economics. Maybe Elon actually does want to make money before he gets Tesla stock going higher. I mean, that almost sounds more reasonable than taking Elon just at his word here, because I think Elon would do and say things a different way if he was being compensated or if his compensation was on the line. This Elon we know today is starkly different than the Elon that we used to see in 2020 and 2021. Every time, someone would talk about shorting Tesla on earnings or something along those lines, I would say, dude, Tesla always pulls through. Tesla always has something extra there that will screw you if you bet against Tesla. Now it's not. I mean, Tesla's fallen 10% the last 4 earnings. That's like Snapchat, okay? That falls 20, 30% like quarter after quarter after quarter upon earnings. It's a different Elon ever since he, fully got through his last comp package. So believe it or not, I am starting to think it is about economics when it comes to Elon, at least a little bit. And Tesla stock will start to perform a lot better once Elon is actually paid. And I think that's the part Dan Ives kind of left out here. And I think that's why he's pushing for this so much. And I do think when the board figures this out with Elon gets another comp package, setting some pretty dang high bars for Tesla. I think things will start to turn around a lot more for Tesla stock. I don't think Elon is unaware of what Wall Street wants, right? I do think Elon understands Wall Street wants profitability at this point. If he doesn't, then someone should tell him, because I think that's pretty obvious. So I do think once his comp package is actually put in play, Tesla will start focusing more on profitability. We've already seen over the past couple of days, Tesla and specifically Elon sent out emails asking different management roles to let HQ essentially know, do they need all of their positions? If a manager is running 500 different employees, do they need 500, or do they maybe only need 450 to get the job done? That potentially is the first sign of Tesla starting to focus on profitability. And Tesla stock has been reacting very good based on that just over the past couple of days. I think more of this is to come, and especially as Jerome Powell starts to actually lower rates, then I think Tesla can incrementally start to raise prices at bare minimum, hold up margins. Like, let's be honest, a rear-wheel drive Model 3 or Model Y with the federal tax credit at $36,000, are you really going to cut prices more from here? If that's what we're all concerned about, is that really going to happen? What? Is it going to be $30,000 next? Highly doubt it. So I think the price cuts are behind us. I think the stock just needs more certainty and more confidence around what's going on with Elon. Is he staying? Is he going? Is there going to be a new comp package? Are they going to move their headquarters? And then ultimately, is Tesla going to focus on profitability, or are they not? Who even cares that Tesla did not provide guidance? Like I said on, the day of Tesla's last earnings when they did not provide guidance, we get so much interim data on Tesla, weekly data out of China, that pretty much daily data out of Europe. We have a pretty good understanding of where demand likely is for Tesla. And all of that considered, Wall Street still has 480,000 deliveries as their estimate for Q1, which is 5,000 less than last quarter, which last quarter was a record. So Q1 could start off on a record, or unfortunately could be a big miss, but that's the good part. Tesla did not provide guidance. But I actually found that quite crazy that Q1 estimates are 480,000 deliveries. That seems high to me, but maybe Tesla can pull it off. Tesla had the best January ever in Europe, and China is really starting off with a bang. Who knows? The US is probably starting off good as well, with the Cybertruck launched, as well as the refreshed Model 3. Things look pretty good from here. Maybe even a little too good in the broader markets. Look at this chart from Bar Chart. They say asset managers are the most long US equity futures in at least the last 15 years. They're more long on US equity futures than 2021, when the markets were arguably in a bubble in certain areas and sectors. And you are way past that right now. Very strange, to be honest. It seems like people are way too bullish, but until we get a hotter than expected CPI report, a more hawkish Fed than expected, or really bad economic data out of nowhere, it seems like companies are, talking the talk and walking the walk when it comes to earnings. Goldman Sachs says our estimate suggests that today's CPI revisions could lower December 6-month annualized core PCE inflation by 0.1 percentage points to 1.8%. That would certainly allow the Fed to start cutting rates. Now, Adam Jonas says, quote, "I owe Toyota an apology. From 2019 through 2021, we predicted the demise of hybrids given changes in regulations, EV adoption, and consumer taste. We were wrong. Hybrids are proving to be a viable transition." Now, I've heard this a lot recently, but it doesn't make a whole lot of sense to me. I don't know what data came out that I missed that shows everyone's ditching pure EVs and they're going to hybrids. I don't know anyone with a hybrid. I don't know anyone that wants a hybrid. If you're going to get a gas car, you get a gas car. If you're going to get an EV, you get an EV. You don't get a damn hybrid, okay? I don't know where this has come from, but I do think in the grand scope of things, I think it's wrong. And I think this is potentially another issue that is plaguing Tesla stock at this point is, for whatever reason, Wall Street now believes people want hybrids. And I think that's far from the truth. So that is going to go ahead and do it for this video. Hit that like button as well as subscribe to the channel. If you guys want to come trade with us, check out that link down below in the description of this video as well. You guys have a great rest of your day, and I will see you in the next one.